You can pull out your phone right now, tap a single button, and instantly own a microscopic slice of the 500 largest companies in America, or a fraction of a vault of gold. Building a diversified portfolio used to require massive capital. You either executed hundreds of individual stock trades, bleeding money on commission minimums, or you handed your cash to an active mutual fund manager and paid steep entry and management fees for their expertise. Commodities posed an even tougher logistical hurdle. If you wanted exposure to crude oil or precious metals, you either figured out how to physically store a barrel of oil, or you bought shares in a mining company, taking on the operational risks of their specific business instead of tracking the asset itself. The financial industry solved these structural problems with two specific vehicles: the Exchange-Traded Fund, or ETF, and the Exchange-Traded Commodity, or ETC. On the surface, they act like standard corporate shares. They are open-ended funds traded directly on a stock exchange, so you can buy and sell them anytime during market hours. Behind the scenes, market makers provide continuous pricing to ensure sufficient liquidity to get you in or out. The true innovation lies beneath that simple interface. It takes highly engineered internal mechanics to mathematically replicate entire global markets in real time. This table shows methods funds use to mirror an index. Full replication buys shares in exact proportions as the target. It perfectly mirrors the index, but constant trading extracts heavy transaction fees. To fix this, providers developed efficient alternatives, stratified sampling, and optimization. Funds use sophisticated computer modeling to select a representative basket of securities matching the broader index, drastically reducing daily trading. But holding only a sample causes a slight performance deviation from the actual index. That gap is known as tracking error. Physical replication forces a strict engineering trade-off. Investors choose between absolute, expensive accuracy and cheaper, modeled approximations. There is a third, entirely separate way to build one of these funds: synthetic replication. In this model, the ETF does not hold a single share of the underlying index. Instead, the provider enters into a swap agreement with a financial counterparty. The ETF passes the return on a predefined basket of assets to the counterparty, and in exchange, the counterparty guarantees to pay the exact return of the target index back to the ETF. This structure nearly eliminates tracking error and drops costs even further. It also introduces counterparty risk, the very real danger that the institution holding the other side of the swap could default on their obligation. These exact replication principles apply to physical goods through exchange-traded commodities. An ETC grants direct exposure to the price of a single commodity, like a barrel of oil or an ounce of gold, without the investor needing to secure transport or physical storage. The mechanics under the hood dictate the reality of the asset. An ETC can be fully backed, meaning the provider actually holds the corresponding amount of physical gold locked in a real vault, or it can be entirely synthetic, relying on the same derivative swap contracts used by ETFs. Whether you track the S&P 500 or the spot price of physical gold, the numbers ticking across your screen rely on distinctly different internal engines, each carrying completely unique risk profiles. By packaging complex replication strategies into single, tradable shares, these vehicles give retail investors the exact same asset allocation toolkits once reserved strictly for massive financial institutions. They slash annual expense ratios, eliminate steep entry and exit charges, and provide continuous, real-time pricing transparency. Warning tone. Because the interface is frictionless, the burden falls entirely on the investor to investigate the underlying architecture. Two ticker symbols tracking the exact same market might look identical on a brokerage app, yet operate on entirely different logic. One holds tangible, physical assets, while the other relies on a fragile web of synthetic promises. Tapping buy on an ETF or an ETC acquires a sophisticated real-time replication engine that scales the global economy down to the palm of your hand.